So what happens when a fintech giant, a company that's supposed to be the bedrock of the entire banking world, suddenly loses over 60% of its value? Well, that is the incredible story of Fidelity National Information Services, or FIS. Today, we're going to open up the investment memo on a company that's right in the middle of a massive, high-stakes turnaround. Okay, let's get into it. Just take a look at this. It's pretty wild. While the market was steadily climbing from 2021, FIS went into a complete and total freefall. And we're not talking about a gradual decline here. This was a collapse. For a blue-chip name that investors really counted on for stability, it just begs the question, how did a business that seemed untouchable get it so wrong? And maybe more importantly for us today, is the worst finally over? To figure that out, we really need to understand what this giant looked like before it stumbled so badly. You see, for decades, FIS was the quiet engine of the financial world. Its whole success was built on being this essential, almost invisible infrastructure for literally thousands of banks. Think of FIS as the central nervous system for the banking industry. Seriously. It provides the core software that lets over 14,000 institutions do everything. Manage customer accounts, process transactions, just function. It's a hugely dominant player, especially with the big banks, and it built this position through really smart, steady acquisitions over the years. And here is the absolutely crucial point. This whole business is protected by a massive competitive moat, and that moat is called high switching costs. Once a bank builds its entire operation on an FIS system, leaving is, well, it's almost unthinkable. This analogy just brilliantly illustrates why. It is not like changing your mobile carrier. It is a deeply complex, incredibly risky procedure that could bring a bank's entire operation to a screeching halt. Because of that, clients almost never leave, which gives FIS this highly predictable, cash-gushing business model. A true fortress. So, you've got this fortress. What in the world could possibly tear it down? Well, in 2019, management took a $43 billion swing that, let's just say, cracked the very foundation of the company. The timeline of the Worldpay acquisition is just staggering. In 2019, FIS pays a premium, $43 billion. Just 3 years later, in 2022, they're forced to admit failure and write down nearly $18 billion of that value. And then, by 2023, they sell off a majority stake in a deal that values the entire business at just $18.5 billion. In less than 4 years, they literally vaporized over half of their investments. The promise was so compelling on paper, right? Combine FIS's banking clients with Worldpay's payment processing to create this unbeatable fintech titan. But the reality? It was a disaster. The integration was fumbled, the two company cultures clashed hard, and critically, FIS starved Worldpay of the investment it needed to compete, just letting all these nimble rivals eat its lunch. And as Morningstar points out, what's so frustrating is that the idea itself wasn't even the problem. The execution was. This massive public failure to deliver on the biggest deal in its history completely shattered investor confidence, and that leads directly to that horrifying stock chart we saw at the beginning. This kind of value destruction demanded a radical change. And you know what? That change started at the very top, with a brand new plan. Get FIS back to what it does best. So in comes new CEO Stephanie Ferris. And here's the interesting part. Having been a leader at Worldpay before the acquisition, she knew exactly where all the bodies were buried. Her mandate was crystal clear. Fix this mess, refocus the company, and start getting value back to shareholders. Her plan was brutally simple and honestly refreshingly direct. Step 1, sell the problem child Worldpay. Get it off the books. Step 2, slash over $1 billion in costs to boost efficiency. Step 3, refocus every single dollar of investment back on the core banking and capital markets business. And step 4, take all the proceeds from that and return them to the investors. And that brings us to the investment case today. With the whole Worldpay saga finally over, the question is, what's left? Is this a company actually worth betting on now? Let's break down the bull and the bear arguments. The bull case starts right here. The remaining core FIS business is an absolute profit machine. An adjusted operating margin of nearly 43% is elite by any standard. It proves that the underlying strength and pricing power of its core operations is still very, very much intact. And yet, despite that incredible profitability, the stock looks cheap. As you can see, it's trading at a really significant discount to its peers,
around 12 times forward earnings versus their 18. So the argument is simple. If management can just prove this is a stable, boring business again, that valuation gap could close, delivering some serious returns to investors. And management is backing this whole thing up with cold, hard cash. They have publicly committed to a massive $7.5 billion in shareholder returns over the next 3 years. That is a powerful signal of confidence in their ability to generate cash and execute this turnaround.
Okay, now for the sobering counterargument. The bear case is that the core business, while it's profitable, is a pretty low growth machine, only expanding at a few percent per year. There's also big execution risk. Can they really cut costs that deep without damaging the business itself? And finally, that moat is strong, but it's not invincible. You've always got new fintechs constantly chipping away at the edges.
Which leaves us with the ultimate question. After stripping away that disastrous merger, have we uncovered a deeply undervalued, high-quality business that's ready to rebound, or is this a classic value trap, a stock that's cheap for a very good reason and destined to underwhelm? The strategy is set. Now it all comes down to execution.